Stephen, I'm going to leave it to you. What's
Wonderful.
with the Fed cut? How did that work out?
Sure. Now, to be clear, and this is always the most important thing for everyone to understand, is that the Fed only controls short-term interest rates, the overnight lending rates that the banks borrow from each other, et cetera, not what you and I can lend on. And so when they lowered in September, for the first time, they lowered 0.5%. At that time, the prime rate, which is the overnight lending rate that you and I, the customers, the consumers use, all of our credit cards and home equity lines of credit are tied to the prime rate. The prime rate was at 8.5%. They lowered it by 0.5% in mid-February to 8%. And then just most recently, last week or the week before, they lowered another 0.25%, the second lowering after all of these years. Now, everyone expected, yay, the Fed's lowering rates. That means mortgage rates are coming down. No. Short-term rates and mortgage rates are completely distinct concepts. Yes, dotted line, everything is connected nowadays globally, but they're very different concepts. Mortgage rates are based on the market. What market you say? The general market, bonds, stocks, and everything, but most specifically the mortgage-backed securities and the bond market, the 10-year bond market. And so when we take a look at this, I'd like to show everyone, Tricia, and I want to really take some of kind of the stigmas out of graphs and such, and really make this simple for everyone to show what's happened since September 17th or 18th when the Fed cut happened. Make this really simple for everyone. So what we're looking at today is called the 10-year U.S. Treasury. It's a 10-year bond. Today we're at 4.41. When we were back at the rate change, it was 3.65. If you see all the way over here on the right-hand side, 3.65.
3.65. I got it.
Now, since that rate change where the Fed cut and lowered short-term rates, the 10-year bond, which is most directly tied to mortgage rates, has been going up and up. And if you see on the right-hand side where that interest rate is going, it's 4.3, 4.3, 4.4. And that's where we are today at 4.4. It has raised virtually from, we're rounding off numbers here, 3.6 to 4.4, 0.8% in interest rate since the Fed has lowered their interest rates. So most people are like, wow, why are mortgage rates so high? Why are they keep going up? For the last 40 years, every time after the Fed does their short-term cuts, in the short run, which is defined by anywhere from 1 to 3 months or so, mortgage rates have always gone up. And part of the reason is because when the Fed starts talking about rates, now what I want to do is I want to go back a little bit on our chart, a little bit further in time so that we can see where they were back in June of this year. When the Fed started talking about lowering rates very seriously, we're in June and July now, we can see that rates really started to come down quickly. We were at 4.27 if you look on the right side of the screen on July 24th. And by August 1st, in about a week, we dropped down to 3.78%. That's a really fast drop. And that was basically because the market built in the rate cuts to come. The rate cuts came all right here in mid-September, and then the market kind of went back to where it was. If you look right here going across, the market's about where it was in June, July of this year before they started to seriously talking about the cuts. So in essence, what happens is everyone gets excited, the rates come down, the mortgage, and this has happened for 40 years, every cycle. Yeah. In essence, all the market is doing now is it's back to where it was. And so where are we waiting now? Where is it going to go now, right? That's the big question. Yeah. Well, now the market will determine that. And the market is determined by all of the things that the Fed has been doing. Here's the interesting thing. They've already started to lower interest rates and the economy really hasn't slowed down enough. That's why we're still up. So if someone
That's what I was going to say to you. So what we really need for interest rates to come down, and correct me if I'm wrong here, is for the economy to be worse than it is.
Correct. And it's not worse than it is. And in fact, it should be worse. That's why we're coming out of our recession from the Fed raising interest rates and slowing down economy, but they're already starting to lower the interest rates again, which is going to start to churn up the economy, yet rates haven't really started to come down. So the real question becomes, what do we do as buyers and consumers now? Because we don't have any control over this market. We know that the trend is still going to be for it to come down. If I go even out further to a 2-year time frame, And we see where we are now compared to where we were, for example, back in the peak of 2023 when rates were at the very highest. This is when I was locking best borrowers 20% down, good credit, everything at 7.99 and 8%. And then, of course, the rates came down. They've gone back up again. They came really nicely down all the way down to when the rate cut happened again in September 18th again. And they've pushed back up pretty quickly. But as we can see with all trends, this will continue to go down. The question is how quickly. So what do we do in the meantime? In the meantime, I think for most buyers, we have to assume that rates not necessarily are going to continue to go up and up and up. The question is, they're going to probably be in this range. Let me go back down to where we are currently. They're probably going to be trading in this range. There's no more peaks for a while, and then eventually will start to come down.
Here's what I've learned from you right now.
Great.
Is that the interest rates came down based on the promise of the cut.
100%.
So the peak time to buy was beginning of August to the beginning of October was the prime time for the interest rates, right?
Correct.
Okay. The other thing is that although they've gone up now, our economy is strong, which is great, and they're not as bad as they were this time last year. So that's all positive stuff.
Correct. 100%.
Okay. So if I want to buy a house today, if I want to take out a loan today, because if I wait 6 months, that this home is going to be worth a lot more, and I don't want to pay a bigger mortgage, but I can't afford the current interest rate. How can I improve my interest rate? What are you telling me to do?
This is a great market for what we call temporary buy downs. Temporary buy downs are where you get your normal mortgage, but for the first 1, 2, or 3 years at max, you get to buy down that rate temporarily. So if your original 30-year fixed starting rate is going to be at 7.5% today, for example, then you can have a temporary buy down that in year 1, it's at 4.5, year 2, 5.5, year 3, 6.5, and then in all subsequent years, you're back at your original rate of 7.5, with, of course, at the hope that somewhere within those first 1, 2, or 3 years that you have the ability to refinance into a lower market rate. Let's say your natural 30-year fixed rate went from a 7.5 down to a 5.5 2 years after you bought the home. Great. Then you refinance into a new 30-year fix.
Who pays for the buy down? Who pays for this?
Theoretically, anyone, a buyer could pay for the buy down, but generally it is the seller who pays for the buy down in the form of a seller credit. And this is the most cost economical way to do that usually. Now, the problem is in a really tough seller's market like it is now, where there's not a lot of inventory and a lot of competition, it's hard to go into a Mr. and Mrs. Seller and say, hey, can I have a $20,000 seller credit so that I can use that to buy down my loan with a temporary buy down, when they have 10 other offers at or above at listing price. So this market has changed certainly in certain areas. There are definitely hot areas. I like to say it just to say it. As of this day, November 22nd, yesterday, I got quotes that in San Jose, California, a home went for 12 offers at $360,000 over list price with a base of 1.6 million. So we are in a hot market in certain areas. Yet I talked to someone in Eastern County County that they only had 2 or 3 offers, and they actually accepted an all-cash offer that was slightly under list price. Those are the markets that start to change, the ones I'm talking about in that kind of Eastern Contra Costa area, for example, where you could very easily go to a seller and say, hi, Mr. and Mrs. Seller, can I have, with my offer, a $10,000 to $20,000 seller credit that I can use for a temporary buy down since interest rates are high right now? Does that make sense?
That sounds fantastic. That sounds like something every real estate agent should know about and should be encouraging their buyers to look for.
Absolutely, because we like to say you date the rate, you marry the home. It's most important to get into the home. Imagine the competition now. Now imagine if the competition at 5% interest rates. Is there going to be more competition for that home or less, Tricia? Come spring, let's say, when interest rates are significantly lower than they are today. We know the answer.
This is great, Stephen. I feel like I learned so much today.
Awesome.
I really
this was a good one. I really appreciate your time. Any other final questions?
Oh, yeah, I do actually. What would have happened to the rates if the Fed hadn't cut them? Where would we be now today?
This is Stephen Seidler's speculation
Yeah.
that if in July of this year, the Fed did not significantly start talk about lowering rates where it was a given, it wasn't if, it was a when. If they hadn't have done that, which then built into the market all of the expectation of the lowering rates, my guess is if we go straight across from here, look at where we are. We're about where we would be. And in fact, all of this extra little push and scariness that's happened is only because it was a rebound. We probably would have even drifted down lower. If you kind of look at this general trend of peaks, and if I kind of just keep it on the same trend, we could even be around here a little bit lower, because that would have been the trend if we hadn't have taken, the expectations of the big market change. So that is a great question.
That's
and my guess is
interesting.
if we probably would have had, ironically, this is a bold statement, if the Fed had not lowered short-term rates, mortgage rates would be lower today. There's my comment.
Mortgage rates would be slightly lower, perhaps, but
Yes.
like you said, this Fed cut affects everything.
Yes, and in the long run, it will be better for everyone. But in the short run, the Fed lowering is hurting us in the short run.
Okay, that's fantastic. I love this. I love it. I love the fact you came up with Stephen Seidler says.
Yep, there we go.
Speculation.
We'll look back at this this time next year and see if we're right.
Okay, well, I learned a lot about buy downs. I learned a lot about the interest rates and what's happening right now. So if anybody is interested in reaching out to Stephen, his contact details are there. Super
Great.
smart guy. I love the way he thinks around a problem and comes up with a solution for buyers, for real estate agents, and for sellers. He's always got your back. So, Stephen, any last words before we say goodbye?
Keep faith. Rates will be going down. Hang in there. Get pre-approved with whoever is your best mortgage lender so that you can be ready to buy when that opportunity comes. Because generally in this winter market where it's the slowest, I just told you how there's multiple offers. There are going to be amazing opportunities if you are ready. And my definition of ready is being fully pre-approved and ready to go in and making offers with no contingencies, etc. in this.
Okay, brilliant. Thanks so much, Stephen. See you again
Thanks,
next
Tricia. I
time.
really
Take
appreciate
care.
you doing this.